It's 1943. World War II is bleeding the Allied forces dry, not on the ground, but in the sky. Bombers are limping back from missions shredded with bullet holes. The damage clusters in the same places every time: the wings, the fuselage, the tail. Military engineers study the patterns and reach what seems like an obvious conclusion: reinforce those areas. More armor, exactly where the enemy is hitting. It was logical. It was data-driven. And it was completely wrong. A statistician named Abraham Wald, working for the Statistical Research Group in New York, looked at the same data and saw something no one else had noticed. "You're putting the armor exactly where it doesn't need to go," he said. Wald understood what the military couldn't see: they were only studying the planes that came back. The ones hit in the engine, hit in the cockpit; those planes weren't in the hangar. They were at the bottom of the ocean, taking their data with them. Today, in the world of personal finance, millions of people are making the exact same mistake. They're studying the planes that returned and completely ignoring the graveyard. This cognitive error has a name: survivorship bias. It's not a conspiracy. It's not fraud. It's something quieter and more dangerous: a systematic distortion where failure gets erased from the dataset, leaving behind only a curated highlight reel of success. In finance, this distortion is not just a theoretical curiosity. It's a measurable, documented phenomenon that inflates your expectations of return before you've invested a single dollar. Here's how it works. When a mutual fund performs poorly, it doesn't hold a press conference. It doesn't send you a letter. It simply disappears. The sponsoring firm quietly merges it into a better-performing fund from the same family. The losing track record gets absorbed and erased from commercial databases. What you see when you look at historical performance tables isn't the average of the market. It's the average of the survivors, the ones that were good enough, or lucky enough, to outlast the selection process. Researchers Edwin Elton, Martin Gruber, and Christopher Blake spent years documenting this mechanism. Their conclusion was unambiguous: the data you're being shown has already been cleaned. And the cleaning process systematically makes the past look better than it actually was. So how big is this distortion? Let's look at what the research actually found. Elton, Gruber, and Blake tracked every single equity mutual fund that existed at the end of 1976, and followed them all the way to 1993. Out of the 2,071 funds in their complete database, they found that non-surviving funds underperformed surviving funds by an average of 4% per year. 4%. Every year. Gone, not because the market was bad, but because those funds were quietly removed from the scoreboard. They called this the attrition bias. An investor who analyzes only the funds that exist today will find return estimates inflated by anywhere from 20 to 80 basis points annually. It doesn't sound catastrophic. But compounded over decades, it reshapes your entire retirement. And researcher Mark Carhart added a finding that makes this even more unsettling: the bias grows over time. In a one-year sample, survivorship bias is almost negligible, barely 0.07%. But in samples spanning more than 15 years, the annual distortion climbs to 1% or more. The implication is striking. The longer and more stable a track record looks, the more likely it is that the record has been scrubbed clean by the elimination of fallen competitors that nobody remembers anymore. You're not looking at a history of performance. You're looking at a history of survival. Survivorship bias doesn't just distort investment data. It shapes the stories we tell ourselves about success itself. Every week, a new documentary celebrates the founder who dropped out of college, slept on a friend's couch, and built a billion-dollar empire through pure grit. These stories are real. But they're not representative. The U.S. Bureau of Labor Statistics tracks what they call business employment dynamics, the actual birth and death rate of businesses over time. The pattern is ruthlessly consistent across decades and industries. Approximately 20% of new businesses fail in year 1, nearly 50% by year 5, and over 65% by year 10. These numbers don't make headlines. The survivor does. And the survivor, interviewed on a podcast or profiled in Forbes, gives you a step-by-step account of exactly what they did right, without ever mentioning the thousands of people who did the exact same things and simply didn't make it. Carhart's research on fund management found the same pattern. The supposed persistence of winners, the idea that today's top performers will be tomorrow's, collapses almost entirely once you adjust the data for survivorship. What looked like skill on Wall Street turns out, in many cases, to be a combination of risk factor exposure and the simple luck of not having been hit in the engine. Just like Wald's bombers. This channel doesn't exist to sell you a mindset. It exists to give you behavioral tools grounded in peer-reviewed science. So here are 3 concrete filters you can apply starting today. Filter 1. Demand the attrition record. Before investing in any fund or strategy that boasts 20 years of outperformance, ask one question: how many comparable funds closed or merged during this same period? If the report doesn't include the fallen, then by definition, the reported return is not the real return. Filter 2. Apply the Wald inversion. Don't only study what successful people or companies did right. Study the failure mechanisms of the businesses that disappeared in your sector. The most structurally useful information is usually not in the winner's memoir, it's in the autopsy of the ones who didn't come back. Filter 3. Adjust for risk and style. Elton and colleagues demonstrated that single index performance comparisons are particularly vulnerable to survivorship distortion. Multi-index models, which evaluate fund returns against multiple risk factors simultaneously, are far more effective at separating genuine skill from luck embedded in a clean dataset. These aren't hacks. They're the analytical equivalent of doing what Wald did, looking at the whole picture, not just the part that survived to be photographed. Financial success is not a story about will or merit. It's a story about probability, data quality, and the management of cognitive errors. The world is full of people selling you the wings of the plane that returned. But your financial future depends on armoring the engine that everyone else ignores. We want to open this up to the community. What company or investment fund that's considered a success story today do you think has simply had the luck to outlast a sector where all its competitors have died? Leave your analysis in the comments. We'll see you in the next episode of Brain and Cash.